Good afternoon and a warm welcome to those of you who are with us and also those online. Welcome to the Center. My name is John Barker. I'm a fellow here at the Center, and it's my pleasure to introduce today's speaker, Dr. Karina Patrício Ferreira Lima, who is Senior Lecturer at the University of Leeds. She will be presenting insights from her forthcoming book on sovereign debt crises. Now, Karina has established herself as a leading voice in international economic law, particularly at the intersection of law, finance, and sovereign debt governance. Her research has earned her notable recognition, particularly the Society of International Economic Law Prize and the John H. Jackson Prize from the Journal of International Economic Law. Now, today's lecture comes at a particularly crucial moment as we observe insolvency crises affecting many nations, and particularly among the world's poorest. This is both an international development issue, but also one that affecting international peace and security. So we locate your subject in a very important place. Dr. Patrício is challenging conventional narratives about sovereign debt and presents a compelling case for establishing an international sovereignty insolvency mechanism. She will speak for 40 minutes, after which we will take questions. And as is our custom, we stop at 2 o'clock sharp. So before I hand over, I'd like to give a shout out to our former Deputy Director, Michael Weibel, who I believe may be visiting us from Vienna, and also welcome to all those others who are online. Dr. Patrício will speak, as I say, for about 40 minutes, and then we'll finish at 2. Thank you. Please welcome, join me in welcoming Dr. Karina Patrício.
Well, thank you. Thank you so much. I'm very, very pleased with this invitation. This center has always been a reference of excellence and inspiration in terms of research. So it's a pleasure to be here. I will try to connect this debate with broader debates in scholarship as well, hopefully, so we can have a chat, a conversation. Of course, this is also a book project, meaning I'll have to select a certain approach to deal with this in 40 minutes. I hope it's effective. And I'll start with, well, a contextualization of this problem we are dealing with today, as John mentioned. And when I say sovereign debt in the age of the polycrisis, I bring up this term, not because only it's topical and many people are talking about it. It's because I believe the polycrisis is also a crisis of multilateralism. And this is why we deal with so many challenges, which are increasingly difficult to address via coordination, right? And debt is one of them, sovereign debt. We are now at a stage where the percentage of IDA, International Development Assistance, eligible countries at high risk of or already in debt distress has doubled since 2015. And I'll elaborate a bit on the reasons for that in a minute. Indermit Gill, the senior chief economist of the World Bank, has described the current situation in the World Bank latest international debt report as a metastasising solvency crisis that continues to be misdiagnosed as a liquidity problem in many of the poorest countries. So here referring specifically to IDA eligible countries, where MDBs, that is multilateral development banks, have now become a sort of international lender of last resort for those countries, because as interest rates went up during 22 and 23 in core jurisdictions by core central banks increased their interest rates. Private creditors have withdrawn from those jurisdictions, leaving those countries without financing sources other than MDB to have stepped in, right? So MDBs are not meant to provide this type of liquidity assistance. Rather, this has been described as a devastating diversion of resources from areas critical to development. I believe the landscape this year, unfortunately, will not improve. It's rather, I believe, it will likely worsen as particularly the US has cut the aid assistance, which for many of the poorest countries is a significant source of financing or financial resources. The dollar is also strengthening as a result of the trade tariffs, which increases debt service burdens on those countries. And potentially, I don't know what's going to happen, who knows, but if the interest rates, if the trade tariffs generate inflationary pressures in the United States, the Fed may increase the interest rates, which will also increase the debt burden, the debt service burden. And let's have a look at that. Here you can see in this graph, also from the International Debt Report, we can see how the interest, basically why has the debt service burden increased so much over the last years. It's not a matter of fiscal responsibility or over borrowing. It's a matter of interest rates, which have gone up significantly. And then refinancing, and this includes all low and middle income countries, not only low income countries, has increased also the debt servicing burden of those countries. And I know this, you probably cannot see, at least, well, people online maybe can see it better, but the first graph we see up there is that interest payments are growing faster than other public expenditures in many countries, including education and health expenditures. We see that here some regions spend more on servicing debt than servicing their people, meaning more on interest payments than health and education. And the bottom graph shows that interest outweighs climate investments in emerging and developing countries in general. So this is, as John mentioned earlier, a matter of development, is how do we finance sustainable development goals? And how do we source, how can we ensure there's enough resources to invest in crucial areas that can ensure socioeconomic development and growth at a global global level, right? So this is very important with crucial implications for development and also social stability, etc. So this is the context where which I'm looking at for this research, and I'm looking at from a legal political economy perspective. So this is the book I mentioned earlier I'm working in, and I'm discussing the role of law. What is the role of law in all of that, right? In creating, shaping, and potentially resolving sovereign debt crisis. What is the law of all of that? And I'm developing a legal political economy framework to analyze the distributive dynamics that unfold during debt restructuring, and advocating for the establishment of an insolvency framework to deal with this, these dynamics. So let's connect that with the broader areas of inquiry in scholarship. I think post-global financial crisis, what we've seen emerging is a range of scholarship across economics, law, political science, sociology, several areas in the social sciences, which is very concerned about rising inequality, both at a global level and domestic level. I think it's fair to say post-global financial crisis, but also we've had new cycles of inquiry, right? COVID has triggered so many questions about the distributional effects of the policies that were adopted then. We are seeing new challenges post-COVID, particularly now with this the exacerbation of this crisis of multilateralism. So the central question of certain, we have different perspectives of this, but one of the central questions is around inequality. And connecting with that, some people also are looking at the political economy of finance, how finance in particular contributes to rising inequality. I think one book, very influential book in the post-global financial crisis context was Piketty's Capital in the 21st Century. I think it's from 2013, if I'm not wrong, where Piketty famously claims that the rate of return on capital exceeds economic growth, and this is leading to rising inequality. This, I believe, has been very inspirational for legal scholarship, because sometimes economists have, I work with economists, it's not a, well, it's just a critique that I think it's constructive. Sometimes they tend to naturalize certain phenomena, right? So the return on capital exceeds economic growth. Of course, I'm simplifying Piketty's book. It's not about Piketty personally, but this is not a natural phenomenon. What are the legal underpinnings of this process? How come capital exceeds economic growth? And we need to look at this. What is the plumbing of this situation, right? And one of the responses, of course, it's not necessarily a response to Piketty, but it's a response to this increasing concern around inequality, is Pister's The Code of Capital, which was launched in 2019, where her central claim is that capital's ability to generate wealth depends on the legal codification of this process. And law determines who benefits from liquidity and who does not. So law and finance have kind of complicated relationship, where law, of course, underpins all the commitments of financial contracts. But at some point, when there is a systemic crisis, law can also suspend those commitments. And in the apex of the system, the core central banks, for example, can inject liquidity at the very top of the system to ensure that the crucial financial commitments are met, so that there is no systemic crisis. So this idea of flexibility and rigidity, please keep it in mind, because it's central to what I'm going to say next. So the idea of law being both a source of flexibility and rigidity. Pister's theory of finance is very concerned primarily about how law creates this flexibility at the apex of the system via central bank liquidity and picking winners at the core. This all has, for me, sort of has inspired my question, which is, this is all very interesting, but what does international economic law, what can it say about this? What about a global account of this legal, rising legal inequality, the legal coding of this global inequality? And what can we say about how law creates rigidity in the periphery of the system? Because it creates flexibility at the core, but what about the rigidity of the periphery? So this is the underpinning of of the research, right? That what I'm trying to answer here. So one of the core claims I want to make today is about sovereign insolvency and how it arises, how it emerges as a phenomenon. Because conventional narratives or sovereign debt literature and also policy about sovereign debt tend to attribute insolvency or sovereign debt crisis to either what is typically denominated as a misfortune or mismanagement. A misfortune can be, for example, some climate event, right? Or some earthquake, etc., that can create significant damage and create a fiscal crisis, or mismanagement can be corruption or overspending, etc. And that tends to underpin moralizing narratives about austerity as being a measure of responsibility towards creditors, etc. Right? So you cannot overspend, etc. Which I won't say, I don't think this is necessarily wrong all the time. There may be episodes of course, misfortune and mismanagement, but essentially sovereign insolvency is a systemic problem of the international monetary system, the way it's built. And that's the remnant of Bretton Woods. It's not the Bretton Woods system. It's this 50-year-long experiment that has endured since the collapse of the original structure of the Bretton Woods system. So it's not necessarily about individual problems, mismanagement, not all the time, because sovereign debt markets are hierarchical in the current international monetary system. And that's something previous research has shown in relation to private markets. Peter talks about that a lot, Perry Merlin. But sovereign debt markets are also hierarchical, and they are shaped in a way that disadvantage peripheral states. That's because liquidity flows pro-cyclically. What do I mean by that? Again, people here in the room may not necessarily see the graph very well, but you just, the graph is only here to show that after each episode of crisis, the East Asian crisis, global financial crisis, the Euro crisis, the Taba tantrum in the United States, where they announced they would finish the quantitative easing program, you see that there are outflows from developing countries. So in times of crisis, money seeks flight to what they call safety or equality. So the flows are pro-cyclical, meaning when you need money the most, that's when you don't get it. And this has crucial implications, which heighten the vulnerability to sovereign debt crisis of the monetary periphery. This graph shows, it's just an update from the previous one. It shows how in 2023, finance flows have turned negative in developing countries, meaning they were financing the core, right? The core of the monetary system, which that was with the interest rates when they went higher. And these features make the monetary periphery more vulnerable to sovereign debt crisis because it essentially affects their fiscal capacity, which is reduced due to exchange rate instability generated by those capital flows. It makes more difficult to roll over sovereign debt. So when they have a maturity date coming up and they need to issue more debt to repay and roll over the sovereign debt, it makes it more costly, and the access is constrained due to liquidity shortage. And the access to the global financial safety net, that means sovereign debt, swap lines, in regional financing arrangements, is much more constrained. I don't have time to elaborate on the swap lines, but we can enter this rabbit hole if you want in the Q&A. But of course, selected numbers of central banks have unlimited and unconditional access to swap lines, meaning they can mitigate liquidity crises during those episodes, and the monetary periphery has limited access. That means liquidity crisis can quickly evolve into solvency crisis. So sovereign debt crises are not only a fiscal policy failure, but they reflect the systemic architecture of the international monetary system. And this is why we need rules to deal with sovereign debt crisis, because they are embedded in the international monetary system. So what is the role of insolvency law in all of that? Well, here you will know, or not, maybe, Minsky was a famous economist, heterodox economist, who famously wrote and show that financial crises are inherent to the cyclical dynamics of capitalism, right? So this is part of the dynamics of finance. And during such crises, if you a rigid adherence to pre-existing commitments, legal commitments, risks exacerbating economic downturns and hindering collective recovery. So there is a macroeconomic effect that can be generated from the strict adherence to legal commitments, right? Peter talked about that in the context of suspending certain commitments and injecting liquidity. But at the same time, insolvency law, and that's perhaps not looking at it from a systemic perspective, but it's also a key element of this puzzle, because it has a key role in the broader financial architecture. It mediates between the enforcement of obligations and the need for flexibility during crisis. So you have a contractual obligation or a tax obligation or tort obligation. And when it becomes untenable to enforce all of those obligations, insolvency law introduces an element that Warren calls escape valve, right? So it's a escape valve to the enforcement of obligations which are generated by other areas of law, right? So it's a key component of the enforcement framework. When enforcing the obligations is impossible, then you have insolvency law. Which allows those claims to be reprioritized, renegotiated, etc. So it's a vital mechanism to manage and redistribute financial risks and to ensure macroeconomic recovery. Otherwise, the recovery can be hindered by the enforcement of other types of obligations. But insolvency law is not available for everyone, right? Peter talks about how liquidity is not available for everyone, but insolvency law is also not available for everyone. So the question of who is protected by insolvency law and how much is a key question of policy and theory as well. So the element of elasticity provided by insolvency law is also not for everyone. Let's have a look at more economic research here and how this connects with law. You will be familiar with the idea of tragedy of the commons, right? So this is typically when you have a shared resource, can be like grazing land or fisheries, anything that is that the community can use broadly. No one can exclude no one in particular. This is a commons. It's the commons, right? Garrett Harding in 1968 wrote about this, what he called the tragedy of the commons. Basically, it's the idea that without enforceable exclusion rights, so if you cannot exclude anyone from using the resource, particular, individuals interacting with it are incentivized to overexploit it. In this case, too many cows, for example, which will destroy the land. However, Elinor Ostrom, who famously won the Nobel Prize of Economics, has shown us that depends on actually whether it will be destroyed or not. It's not inevitable. It depends on the institutional arrangements in place to regulate the use of the resource, monitor its use, and enforce rules. And those institutional arrangements that's what she calls working rules. We need to keep this in mind, because the working rules are not necessarily just a product of formal legal rules, but they can be de facto rules, they can be just customary rules. It doesn't matter, it's how the system works, it's the rules of the system. So I draw upon this concept of working rules to analyze what happens in relation to sovereign debt, right? So you have a sovereign insolvency crisis. I know there is a lot here, but we have the pie, right? The pie is the fiscal commons of the state. And we have different stakeholders involved in this situation. We have, on the one hand, non-creditor stakeholders. These are individuals or collectives who hold lawful claims on the fiscal commons. So that can be under domestic public law, can be international law. That's where human rights law fits into this. For those of you who are interested, for example, wages, public services, investments, key investment on sustainable development goals, etc. On the other hand, you have creditors. So these are those who hold contractual or quasi-contractual claims, meaning here, for example, IMF loans, etc., on the fiscal common, so commercial, bilateral, multilateral creditors. So these are stakeholders in the common pool resource of sovereign debt. We don't have insolvency rules here, right? So I talked about the flexibility afforded by insolvency law, etc. They don't exist in this case. I must say, of course, I'm presuming some prior knowledge of the audience. Perhaps I should contextualize. We don't have an insolvency framework, right? So when a sovereign faces a sovereign debt crisis, they need to negotiate either one by one with creditors. We have commercial creditors. We have official creditors who provide bilateral loans, who are typically gathered with the Paris Club, but also we have emerging non-Paris Club creditors, such as China, for example, the Gulf states. China is now the largest bilateral lender, so this is not, it's an important point that the official creditors are not gathered under the same forum. This is creating significant distributive conflicts, which I'll mention after that. We have bondholder committees, creditor committees, sometimes involving commercial banks too, but there is no single forum for the renegotiation of these debts. In relation to low-income countries, the G20 has been organizing a forum which we denominate common framework for the negotiation of the debt treatments, but this is an ad hoc process which has no binding rules of engagement to bind creditors into the process, right? So there is no insolvency mechanism, and this is all voluntary and ad hoc. So this is what I mean by the absence of insolvency rules. And in the absence of such rules, it's not like we don't have a working system. The working system exists. The question becomes, what are the rules of the working system? There is no such thing as absence of working system rules. So what are the rules? And the distribution of losses are made according to those rules, and they are shaped by multiple domestic and international legal frameworks. So here, as I mentioned, public law, domestic public law, international public law, but also commercial law, the commercial law of different jurisdictions, mainly New York and England, as core jurisdictions for the issuance of foreign debt. Perhaps there may be some domestic debt under the law of the distressed state. So then it becomes a distributive conflict where stakeholders, acting rationally, by the way, because they will try to minimize their losses as much as possible, will be incentivized to behave like Hardings over razors. Like, so they will prioritize their own recoveries, leveraging the legal tools they have, whatever legal tools they have to over-extract resources. So we have a self-reinforcing cycle of over-appropriation in the working rules of this system, exacerbating inter-creditor inequities and also inter-stakeholder inequities involving the non-creditors too. And this is a source of systemic rigidity for the states which are more vulnerable to sovereign debt crises, typically in the global periphery, right? So this is how I connect with the previous question of, you know, what is the source of rigidity in the law here? And it's precisely this, the working rules of a system where there is no mechanism to coordinate, to create cooperative coordination, but rather it's destructive over-appropriation. So this system creates essentially two dynamics, which I denominate tragedy of the commons and the anti-commons. The tragedy of the commons in sovereign debt is not necessarily new as a framework, but The way perhaps I structured it is different, but essentially, the idea is that in the absence of working rules to transform this destructive competition into sustainable cooperation, we have two dynamics within the tragedy of the commons. One is the attempt to shift costs onto non-creditor stakeholders. And this is done, for example, via market pressure to on the IMF for the IMF to say that debt is sustainable on the debt sustainability assessments. Because if you say debt is sustainable, then there is no need to restructure, then you keep servicing the debt. But essentially, you're imposing austerity on the non-creditor stakeholder to generate those resources. Or if debt sustainability assessment is made and debt is found to be unsustainable, maybe also there is pressure to in regard to the extent to which it's unsustainable, right? So this is also disputed. Another way the tragedy of the commons manifests is through shifting losses onto other creditors. So that's creditors shifting losses onto others. And this is done via several means, free riding on others' losses entirely, for example, holding out. This can be holding out from the negotiation or litigation strategies, which I will elaborate in a second on. We have new innovations like most favored creditor clauses, right? So it's if you negotiate better terms with another creditor after you negotiate with me, then you need to give me the same terms. So it's a way to minimize losses. Comparability of treatment principles. This is a Paris Club. It's a creation of the Paris Club that basically the principle says if you grant certain terms to me as a creditor, you, in this case, official creditors, you need to see comparable treatment from commercial creditors. This is there is a lot to say on comparability of treatment. I'll leave it there just to illustrate the argument, just for sake of argument here. But these tactics are all allowed and coded in law, right? It's a way to rationally reduce your, mitigate your losses. The other type of dynamic, which is an institutional failure, I think it's more recent, and I haven't seen this before in the context of sovereign debt, so this is more innovative, is the idea of tragedy of the anti-commons. The anti-commons is a situation where you have too many people with exclusion rights. It's the opposite of the commons, right? No one can exclude anyone in the tragedy of the commons. In the tragedy of the anti-commons, everyone can exclude everyone else. So no one uses, no one can decide on the use of the specific resource. And in this case, I'm extrapolating the argument to say, to talk about the G20's common framework, which is a forum for the negotiation of low-income country debt that gathers Paris Club creditors, non-Paris Club creditors, commercial creditors, etc. Because there are no binding enforcement mechanisms in this process, every creditor in practice, in latest restructuring processes, has gained sort of veto power over the negotiation. So this is leading to delays, significant delays, and also there is no guarantee that the restructuring process will deliver sustainability in the end, because it's always the terms of the most reluctant creditor, or at least we can see that in cases, recent cases. So I'll have to be very concise here, but one way, for example, the tragedy of the common manifests, where one creditor can impose losses on others, there are several legal mechanisms for that. You create a de facto seniority right in the working system, right? The working rules of the system. That, for example, governing law, you pick English or New York law, which will typically insulate contractual claims from insolvency issues. I can elaborate on that in the Q&A if you're interested, but other structures would be, for example, the weakening of sovereign immunity, allowing countries to sue creditors to sue countries, collateralization structures allowing you to ring-fence assets from other creditors, typically offshore, typically confidentially or under non-transparent conditions, and litigation strategies, etc. So these are ways that you can create a de facto seniority right. This illustrates how litigation tactics have increased. These are typically connected to commercial creditors, which have become more prominent in sovereign debt markets in the last decades. So you see here how litigation during the 1980s only involved 5% of restructurings, and after the year 2000, it's now from 30 to 50%, typically involving high risk distressed debt funds, but also banks, exporters, insurance companies, etc. We can come back to that later. So this is an example of the anti-commons, right? So I talked about the commons. Now the anti-common is the mutual veto power of different creditors. An example would be, for example, Zambia's restructuring under the common framework. Zambia defaulted in 2020. You can see again here for the audience, maybe the graph is not totally clear, but you'll see that it's a pie chart broadly split into three, right? Three equal pieces. And that's the typical debt profile that is now has become very complicated to restructure. That's where you have private creditors, official creditors, multilaterals, and among the official creditors, you have Paris Club and you have non-Paris Club. In this case, China was a very important creditor. And when I say China, it's not a unifying concept that you have different Chinese policy banks involved. There was no consensus on how to measure comparability of treatment, which is now a major challenge. I can elaborate on that in the Q&A if you're interested, but typically the bondholders want liquidity now very fast. Typically, Chinese policy banks do not want to provide any principal reduction, only extensions. That makes it very difficult to measure the net present value in terms of comparable treatment. Private creditors wanted state contingent clauses, which they got in the end, which now have raised concerns about debt sustainability in Zambia. So essentially what happened here, they took over a year to secure financing assurances by the IMF due to disputes between classes of creditors. In the meantime, Zambia got no support. This exacerbated instability, the financial instability within the country. There were multiple rounds of proposals and revisions. So this is what I mean by the anti-commons, right? Because the official creditor committee vetoed the proposal several times, and it's back and forth. So I can elaborate on that also if you're interested later. So just to conclude, why do we need insolvency rules? Essentially, this would address or at least mitigate. I don't think it's a panacea. Of course, insolvency law in the private sector also raises several different, both tragedies also exist in insolvency law, but it would mitigate them by enabling class-specific negotiations, eliminating holdouts through the imposition of binding rules of engagement. So this would provide flexibility to negotiate restructuring terms. So the rigidity here would be procedural. So it's a binding rule of engagement, allowing the stakeholders to negotiate the terms. So this would be very similar to, at least the way I think about it, current restructuring processes under UK company law, for example, like restructuring schemes of arrangement, restructuring plans. So it's a more, the rigidity there is procedural, right? It's not about necessarily rules, because every case is different. Rules for, that's how I see it, at least. Imposing a standstill so that creditors cannot sue countries during the process, and some type of cross-class crackdown to prevent any single class from vetoing the process. Domestic law here can help uphold the standstill. and limit creditor recovery to the terms that were negotiated on whichever forum is designated for that purpose. I can elaborate on that too. I'll leave it here because I am conscious about the time, but there is something I'm working on. This is not about the book, but it's a parallel project, which is a bill that enforces comparability of treatment, and it draws upon this idea that I'm mentioning here. It's a type of safe harbor legislation. So there is no interference with the terms of the contract, but it's about the enforcement of the contract. So it's to prevent creditors from enforcing more than the terms that were negotiated. So this is the bill. It was discussed yesterday in Parliament, the backbench debate. It's scheduled for debate next month. So we'll see. I'll leave it here and we can have a chat. Thank you.